Now, as Malaysia prepares to table its budget 2026, attention is turning to how the government plans to balance fiscal discipline with economic growth amid a challenging global environment. While no major tax changes expanding the capital gains tax, introducing new forms of taxation and improving compliance through digitalization. Now, at the same time, Malaysia, like many countries, faces the delicate task of strengthening its revenue base without hurting investor confidence or slowing recovery. Now, to help us unpack the tax industry's expectations and wish list ahead of Budget 2026, we're joined by HARVINDAR Singh, Council Member of the Chartered Tax Institute of Malaysia. Harvey, thanks for joining us. Now, many expect Malaysia to maintain its current tax structure this year. Now, from your view, should the government continue that stability, or is it time for gradual reform given the global economic shifts we're seeing?
Firstly, thank you so much, ELANE, for having me on board. And I think, as we all know, Malaysia's tax and regulatory framework has seen sweeping changes, right, over the recent years, from the expansion of SST and introduction of capital gains tax, the global minimum tax, and not to mention the invoicing rollout, which has taken place over the last. And, I think it's all quite overwhelming, I would say. And so at this stage, it's probably a good idea to push for stability. Certainly, any frequent or radical tax shifts can complicate planning and generate political well. And in the current, looking at it from a medium-term environment of relatively slow growth globally, preserving confidence is probably more important than chasing incremental revenue. And in any case, many of the low-hanging fruits, right, as far as tax reforms are concerned, have to a large extent already been introduced, right? If you talk about invoicing, digitalization, the base broadening of indirect taxes. So any further wholesale structural changes may yield diminishing returns relative to the disruption that they would cause. And if at all at this stage, some sort of gradual reform by having a multi-year tax program or plan is, which is probably something that could be looked at, by providing taxpayers with clarity, right, on potential tax changes or changes the tax landscape in the foreseeable future.
Now, that's good to hear. I mean, stability seems like a prudent sort of path to walk on at this point of time. Now, there's talk of expanding Malaysia's capital gains tax to include listed shares, something already in place in a number of other countries. Do you think Malaysia is ready for that step, Harvey?
Well, I guess in the first place, the business case for encouraging that is to align with the ability to pay concept or principle, so that those that are earning from capital appreciation, they can afford to have such investments, should contribute to taxes. And also, perhaps, if you talk about curbing speculation and encouraging longer-term holdings, which tends to stabilize markets as well. But equity markets are pretty sensitive and mobile. Imposing on the disposal of listed shares may deter trading volume, reduce liquidity, and possibly push activities offshore as well. Further to that, some real practical issues like valuation, timing of taxing, and looking at complex, questions can be complex. And certainly, I think the political pushback will be strong as well, and many retail investors and fund managers will probably resist it. So all in all, I think it's probably not the most opportune time to expand the scope of CGT to shares as well.
Now, thanks, Harvey. I understand that we might have risks involved with that step. Now, we've also heard proposals for inheritance and health-related taxes, similar to what some advanced economies have adopted. Would those be practical or premature in Malaysia's current context?
Well, I think we've heard this discussion about inheritance tax the last couple of years being mooted. But I think, again, given Malaysia's current tax infrastructure, architecture, and political sensitivity, right, I think inheritance taxes might be a little bit too ambitious at this stage. Of course, the idea would be to raise revenue from the very wealthy, to encourage generational fairness, and to reduce dynastic accumulation of wealth. But administratively, it's pretty tricky. Things like asset valuation, cross-border estates, and dealing with issues, and the real risk again of capital flight is there as well. So I think between if you talk about inheritance taxes or the more feasible ones, things like health-related taxes, sin taxes are probably more feasible, and they can also produce dual benefits, disincentives for behavior, plus revenue that could be earmarked for healthcare or public health, and things like I think the timing may be more palatable for sin taxes, especially, as I said, if tied to visible health needs. Example, funding medical infrastructure and universal coverage expansion. So my take would be that it's probably premature right now to talk about inheritance taxes. Better reserved for a later date when administrative capacity and political consensus are probably stronger. But health-related or sin taxes are maybe more realistic as incremental steps for now.
Now, the government has been pushing digital tools like e-invoicing and tax identification numbers to widen the tax base, a move aligned with global best practices. Now, how effective have these been so far, and what more is needed to strengthen compliance?
Actually, as we know, e-invoicing has been rolled out since August last year, and we are in the middle of the phase three of the five phases of implementation. And many taxpayers are still in, I suppose, called mid-readiness. Some have incurred IT upgrading, courses and all that. There are training needs, and there's certainly a lot of clarity and guidance still required from the tax authorities and from the Ministry of Finance. Overall, I think for the large taxpayers, there's positive sentiment to support the e-invoicing initiative because long-term benefits in the form of a reduction of audit risks, documentation integrity, and professional efficiency can be achieved. But again, many taxpayers are still not ready. I think you could say about 50% readiness is there. It's important for the government for the successful implementation of invoicing to raise compliance levels, and it's also the tool that's used to have a broader rollout of the team, right, to widen the base and reduce tax leakages. I suppose it's important at the same time that some tolerance maintained went for errors that take place early on in the implementation, with limited penalties until the systems mature, right? And there's a need to focus on the providing assistive infrastructure, subsidies or templates, and providing easy onboarding for SMEs and micro businesses as well. Of course, the benefits of e-invoicing are amazing if used, positively and correctly. Once data is digital, tax authorities can deploy smarter compliance methods and systems, right? Audits and nudges in the form of reminders and warnings rather than heavy-handed audits. So in short, I suppose we could say that digital tools are essential. We recognize the need for them. It is being deployed systematically. We are making headway, but the transition is still fragile. And success depends on the execution, support, and willingness of the authorities to also adjust, mid-cost to tweak and then to accommodate business and requirements of the industry.
Harvey, I think you nailed it on the head by saying that support is really important. Now, finally, as Malaysia walks the fine line between fiscal consolidation and economic growth, what would be the top wish list item from the tax industry to ensure sustainable and investor-friendly fiscal policy in 2026?
Well, I think when it comes to the types of tax reforms that are needed to raise revenues, these have been introduced to a large extent in the country. And what's important is, of course, the proper and simple implementation, gaps in terms of compliance leakages, fragility of enforcement, and lack of trust and communication needs to be managed as well. And I think on a moving forward basis, there needs to be clarity, certainty in the types of taxes that may be coming in down the track. We've been talking about this for some time as well, that a transparent multi-year tax reform roadmap, which provides taxpayers with clarity on the tax landscape in the foreseeable future, at least over the midterm, would be very useful and important. So instead of having changes that are introduced on a yearly basis at the budget, we need to look at maybe a 3-year term or 5-year term, right? To look at how do we achieve greater tax collection, greater compliance levels, and raising the revenues that obviously are important for economic development and nation building.
Thank you so much, Harvey. I'm looking forward to what's going to be announced for Budget 2026, and hopefully there will be that roadmap for us to be able to have more clarity moving forward. That was Harvinder Singh, Council Member of the Chartered Tax Institute of Malaysia. Now I'm off for a quick break. When I come back, Harvinder Singh joins me. We'll talk about what's on the tax wish list. Stay tuned.